This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Powell hits the launch button, and the market's leading driver delivers on the quarter and into the future. We'll look at the details of both in this week's Wise Investor Show. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, one of the team's portfolio managers, and it's been a big week since our last recording, especially since last week's broadcast, which was recorded right before Jerome Powell made his speech in Jackson Hole. And while that might not have really changed anything, it did reaffirm some positive expectations for monetary policy for the next couple of quarters, and the market saw a huge rally last Friday because of it. A rally which so far has been sustained through this whole week, with the Dow up over 7% now for the year and the S&P 500 up a bit over 10% for the year. The other big news of the week was that the leader of the pack, NVIDIA, they released their earnings this week, but I'll circle back to that later on. First, I'm going to start with a final thought. That's weird, but I want to get to it, get it out of the way. You know, news is coming at us really hard and fast right now. And a lot of it may have really little impact on our portfolios or how we think about exposure to risk in our portfolios. But this news, which may or may not even have secondary or tertiary economic ramifications, well, it gets some people to give some pause anyway. Also, though, the market ain't especially cheap here. The S&P 500 is trading at over 22 times the forward consensus estimate, according to FactSet. And you balance that with, for the second quarter, the S&P had a combined earnings growth rate of almost 12%. That's pretty good. That's actually the third consecutive quarter of earnings growth. So the final thought to open the show is that while people love evoking Warren Buffett's rule number one, don't lose money, I hear it reiterated. I often hear it co-opted. In fact, just recently, I heard it used by folks over at Blackstone who said that that's their rule number one. But it is a good rule. It's a good rule to keep in mind when you're looking to deploy your capital, when you're making investments. But also, another thought that I would keep at hand, maybe enhancing that rule number one, especially in trying times, times when the market is seemingly expensive, or times when the standards and norms seem to be under fire, is if you have time horizon on your side, you have years on your side, then cut through the you-know-what and continue to seek to acquire shares in great businesses. If you continue to build positions in just great companies, then maybe you could be a bit more agnostic regarding price, a bit on valuation, and also afford the ability to maybe look past the day's headlines. But back to those headlines, it's been a week or so here. This week, we got the August reading on consumer confidence. And, you know, I'm saying that because that's an area of focus that I keep bringing up, and I emphasized it in my December podcast as a key element to keep an eye on this year. And it showed this week that we're still in pretty good shape. The consumer, you know, certainly may be facing some inflation, but as I've recently pointed out, the average American consumer has statistically seen their wages grow faster than inflation and has done so for almost 3 years now. And for August, the reading was ahead of the consensus estimate on FactSet, you know, albeit a wee blip lower than the July reading. So the consumer is still in pretty strong shape. And as I said earlier, the big news of the last few trading days, though, was definitely the interpretation of the Fed chair's remarks at the Jackson Hole Economic Symposium, which was held last Friday. And what stood out for Wall Street was that the labor market is cooling but stable, suggesting that we're not in trouble economically, but it paves the path for rate cuts here in September so that we can stay out of trouble. Powell said, quote, payroll job growth slowed to an average pace of only 35,000 per month. The unemployment rate stands at a historically low level of 4.2%, end quote. Now, of course, that's not historically an unprecedented low print for unemployment. It's been lower recently. But with the unemployment rate within 1% of what is generally accepted as full employment, it's a pretty strong number. And it's not at full employment, but it makes the case for some love for lower rates so that we stay there and we get to that kind of mid 3% number. He further went on to say that growth was slowing, saying that, quote, the decline in growth has largely reflected a slowdown in consumer spending, end quote. But that conclusion may be challenged by the next meeting because of those consumer confidence numbers I mentioned earlier, along with GDP data we got on Thursday. Those numbers suggested that the economy grew by 3.3% in the second quarter. Now, that's actually a bit higher than the consensus estimate, but it's also true that the annualized growth rate was still modest. That 3.3% was quarter over quarter. Annual growth rate for the quarter was revised 2.1%, which was Powell's basis for that statement. Also, you may think caution could be taken from his seemingly hawkish comments on inflation and tariffs, because he said, quote, higher tariffs have begun to push up prices in some categories of goods, end quote. And also continuing, he went on to say, quote, core PCE prices rose 2.9%, above their level a year ago, end quote. But he did clarify and, importantly, I think, satisfied the markets by saying that the effects of the tariffs remain to be seen. And he went on to seemingly downplay the focus as much on inflation over employment as that focus by saying, quote, and this is the big one here, most measures of longer-term expectations remain consistent with our 2% inflation goal, end quote. That the markets took as time to hit the gas and took off. Lastly, as far as what struck me from his speech, he said that the neutral rate may be higher today than it was a decade ago, suggesting, and the neutral rate is where they're at perfect balance, neither fighting inflation nor trying to fight unemployment. And he said that based on the neutral rate is actually maybe higher than previously expected, that if you're above it, you're not as far above it, nor therefore as restrictive as one might think. But overall, the speech was certainly heralded as dovish on rates, and it supported the case for cuts for the following Fed meetings. Now, the markets responded very strongly to this news, rallying over just 1.5% that afternoon. That afternoon had 9 out of 10 stocks on the New York Stock Exchange trading up for the day. And today, almost a week later, the markets are over 2% higher than the day's close before he made that speech. Now, I wouldn't bet against that trend or predict that these expectations are wrong. I'm largely in line with them. However, being that cautious person that I am, maybe we should all just be a bit wary of how much now the market has staked on these rate cuts and bet on these rate cuts, just in case we get a rude surprise. All right, I'm going to jump into a quick break here, but I'll return in a moment with an update on a stock, one that's in the portfolio and kind of key to the markets right now. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
The Magnificent Seven have become the Lagnificent Seven. The clear leaders of the past 2 years are now bringing up the rear. Is this just a correction or something worse? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. In addition to that tailwind the market has been receiving from this kind of evolving monetary policy stimulus, of course, the markets for some time now have been led by this kind of booming economic force of the burgeoning artificial intelligence business, economy, and all of the spending that's associated with both utilizing it and supporting the networks and the infrastructure and the data that drives it. And this Wednesday, we got results from what I'll say is the bellwether of the space, NVIDIA, who released their second quarter results. And what was most remarkable to me at first, really, was how little volatility there was in the stock. I mean, one way or another, I didn't know up or down based on kind of the focus on this stock and what we've seen in recent quarters. I really expected that this sucker was going to move on Thursday. I didn't bet on it, but you just expect a stock like that's going to move after its earnings release. But while it did initially trade a bit lower in the morning, despite that it beat the FactSet consensus estimate on both earnings, on revenues, they raised their full-year guidance above the street's existing estimates, and also they beat on margins. But by the time I came into the studio today to record the show, the stock was basically flat for the day, down a little bit, but like less than 0.5%, which I guess is a pretty solid outcome since it's really within about 2% of its all-time recent high, and the company is still worth over $4 trillion, close to $4.5 trillion in total market cap, and still actually trading at over 4% higher than where it was the day it closed before Jerome Powell juiced up the markets last week. Now, I almost forgot my disclaimer here, which is that I do own shares of NVIDIA, and we own it for our clients and most of our managed portfolios. So I'm coming to you here with an opinion that's biased to the upside. But here, let me see what other folks are here to say about the results. Over at Goldman Sachs, which has it rated a buy and a $200 price target, they said that they too expected it to trade lower on the day because of a, quote, a backdrop of elevated expectations, end quote. But they saw positive signs in their production volume, which is becoming kind of the metric that the street is looking at right now, since the thesis is that the company is going to sell as many of their high-end chips as they can produce, so people want to know how much volume they can actually handle. Goldman did go on to say that the Chinese market remains less clear because of uncertainty around the demand for NVIDIA's lower-end chips, as well as the unknown potential for export licenses for their higher-end chips, the Blackwell chips. And, that very well may be why the stock actually traded up off of its initial lows in the morning, because of a reporter over on the Fox News network tweeted right before the market opened on Thursday that the company was in active talks now with the U.S. government to be able to sell the Blackwell chips to China. An analyst over at Stifel said that the overall results for the quarter were better than their expectations, but clarified that the beat was driven by NVIDIA's gaming chips, which those are actually how the company really got started and the driver behind their business for the decades before the last few years. And its data center chips, though, were actually a slight miss for the quarter. But they weren't too concerned about that, apparently, because the company's guidance for the current quarter were ahead of their expectations for those data center chips. Again, it's being just kind of driven by NVIDIA's capacity to be able to how many of these chips they can produce to meet that demand. Now, not trying to be cute here, but I really couldn't find any major reports that were too negative on this name. I'm trying to be balanced, but in order to offer some balance here, I'll share Goldman Sachs' disclaimer at the end of their report, which is the risks to their estimates. And their risks that they named were somewhat obvious, that the key downside risks would be a slowdown in AI infrastructure spending, increasing competition, or supply constraints. Now, not that these wouldn't be huge negatives for the stock. They absolutely would be what to be on guard for, but it's just saying, like, if a company does badly, it's going to do badly. So, yes, those are the areas that you have to watch out for as the years roll forward, and we'll talk more about that in a second. But We got an analyst over at D.A. Davidson, and this was the least positive report I can find. They have the stock ranked neutral, although they did elevate their price target to $195 a share from $135 a share. And there was almost kind of a mea culpa in this report because they said their primary concern is the company's ability to sell chips in China. But they also went on to point out that new shifts in AI models suggest non-imminent decrease in demand for compute power and therefore NVIDIA's products. But then they said that, quote, despite being sidelined, meaning them being sidelined, the analysts, there has been a shift in perspective, no longer seeing AI cycle peak in 2025 as recent AI model advancements and rapid adoption suggest sustained interference demand growth, end quote. So I guess these guys had been the bold outliers against the stock, and now they've given that up and have fallen back with the pack. Not necessarily a good sign for the last contrarian to no longer be contrarian. An analyst over at Wedbush seems to be allaying anyone's fears about sales into the Chinese market because their primary takeaway was that, quote, the beat is reflecting a $4 billion drop in Chinese revenue for the quarter, but the supply is ready to ship as geopolitical issues resolve, end quote. And in the company's quarterly call, which is where I guess the analyst got this from, NVIDIA said that there were no H2O chips sales for the quarter, but they also project a $3 to $4 trillion AI infrastructure spending total by the end of the decade. This is the Wedbush people saying that NVIDIA is in the leading position to benefit from this $3 to $4 trillion in spending. Now, that's a big hole to fly a plane through, $3 to $4 trillion. But either way, a lot of money still flowing into the space. And, you know, while the story for AI in general, really, it does generally seem to be firmly in place, it's still, regardless of these outlooks and maybe your outlook, it's going to have to justify the valuations of such companies today. Because, you know, here at NVIDIA at about $180 a share, it's at over 40 times the consensus estimate for next year. So any investors buying it here or holding the shares here, they're not banking on just them meeting those estimates for next year, maybe beating them for next year, but banking on a 3 and 4 and 5 year outlook for what's still to come. And over at JP Morgan, where they have the stock as an overweight and they increased their price target to $215 a share, they expect the company to earn $6.63 a share in 2027, which is 27 times the 2027 estimate from today's price. And I said in my disclaimer, I'm biased in favor of this name, but keep this in mind as we move along in the coming quarters and years from here, because as we get through 2025 and, of course, 2026, not only is it going to have to exceed these estimates, but this company and the AI phenomenon as a whole has got to stay on track with continued growth beyond that to continue to support and provide growth above where these stocks are trading today. And, you know, I've said it before, it has not really the hallmarks, just kind of the scent of that dot-com boom of the late 90s. I think this is a lot more real, and there's a lot more sustainable about this growth and the spending, the capital spending. We've talked a lot about the dollar spending in it. But still, the valuations and the extent of time being priced into these valuations is the struggle. You know, this future in general still looks very promising, but these warnings from Goldman Sachs that I mentioned almost tongue-in-cheek weren't impossible to imagine. And get back to that first rule that we talked about earlier in the podcast about losing money. With that, you know, make sure you don't, if you've owned the stock for years, you probably have a large position in it if you haven't touched it because it's done very well. And if you've owned a few of these AI-adjacent companies, maybe grown to be a large portion of your portfolio. So this was an encouraging story about the fundamentals of it, but also a warning about keep that risk in mind as well. Look for opportunities to right-size the position, to continue to participate in the promising future, but protect against what you cannot predict. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in, and have a great holiday weekend.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.